good evening or good morning, everyone, depending on where you are on the globe, and welcome to today's special webinars. So this webinar is a collaboration between the E-Axis Forum and the European Banking Institute. This explains the unusual day of the week for the E-Axis followers. And E-Axis and the EBA teamed up to address a key issue for central bank and supervisors, climate stress test. So as you know, climate stress tests have been a key instrument for central banks and supervisors to analyze climate change, the transition to a low carbon economy, and their consequences for the financial sector, but also for the economy more generally. And so far, central banks and supervisors have used climate stress tests to improve their knowledge of the economic and financial unfoldings of climate change and the transition. But they have also used it as an entry point sometimes to engage with the financial sector on issues like climate risk management and to evaluate the practices. Climate stress tests can also potentially be used to inform policy decision or to serve as indicator of climate risk for firms in the economy and the financial sector. So all these aspects make climate stress test a central instrument in the toolbox that central banks and supervisors can rely on to steer their action regarding climate change. Yet performing climate stress test is not an easy task. So it's a new instrument, and it had to be developed very rapidly from scratch by central banks and supervisors in the latest last years. Climate stress tests also build on complex models, linking physical, economic, and financial dimension. They rely on a lot of hypotheses that cannot be always tested or validated by a past observation. And they request data that are not always available or are subject to large uncertainty. So despite all these challenges, central banks and supervisors have embarked on the development of and the use of climate stress tests. And with this webinar, we would like to shed light on what central banks and supervisors have learned in implementing a stress test. What are the challenges that they faced, and the choice they had to make to build their framework. And the idea is to inform both central banks and supervisors that would like to embark on this exercise or are starting to do it, to trigger also academic research and solution to help them, and basically for everyone to understand where do we stand now with climate stress test and where they can be useful in policy decision or in financial decision. So for this, I have the great pleasure to welcome three panelists from three different central banks that have all gone through this exercise of climate stress test. So by order of the central banks that started all that, we first have Cassandra Archer from the Bank of England. So the Bank of England is a pioneer in climate stress testing, and to my knowledge, it is the first central bank that performed such a stress test. And Cassandra will tell us more about the experience. Cassandra is the co-head of the Climate Hub at the Bank of England, which is responsible for the Bank of England policy response to financial risk arising from climate change and the transition to a net zero economy. The Climate Hub team is involved in the Bank of England's climate biennial exploratory scenario, CBES, and also works internationally with other central banks via the NGFS to develop reference scenario to assess the risks that climate change may pose for the macroeconomy and the financial system. More specifically, Cassandra is an FIA qualified actuary with more than 10 years of experience in financial services, delivering strategic projects, undertaking mergers and acquisition, and developing risk transfer solution across the world. I hope that I described you well, Cassandra. Welcome. We also have Julia Trabert, who is a senior supervisor at the European Central Bank. So you probably know that the ECB has performed recently a system-wide stress test, and Julia will tell us more about the experience. Julia has been working for 10 years in the field of banking regulation and supervision. She joined the ECB in 2017 and is responsible for the direct supervision of significant institutions in the euro area. She is part of the ECB horizontal team on climate and environmental risk, assessing current methodology across institutions and driving the development of supervisory approach. And then previously, Julia worked as a regulatory manager as a Deutsche Bank Group, as well as manager as KPMG Regulatory Services team. So welcome, Julia. And finally, we have Schelling from the Swiss National Bank. So the SNB has also performed a stress test recently, and Tan will tell us more about its specificities. Tan is a senior economist at the Financial Stability Division of the Swiss National Bank. He has 15 years of experience in analyzing potential source of risk to the financial system and in contributing to the design and implementation of the regulatory framework for banks in Switzerland. In the last 3 years, he has been leading the effort at the SNB to acquire a better understanding of climate-related financial risk at the two big banks in Switzerland. Before turning to the panelists, let me remind you that you can post questions in the Q&A app on the bottom of the screen, and we will address this question after a first round of introductory remarks by each panelist. So let me now turn to Julia for that. Can you share with us the initial remark about the ECB climate stress test and start basically the discussion? Thank you. We can see your slide.
Thank you. This is perfect. Thank you very much, Pierre, for the introduction, and also thank you a lot for AXS and EBI for organizing this really interesting event. And Pierre, as you said, stress testing is really a useful tool to assess under different scenarios the resilience of the financial sector on the one hand, but also of individual financial institutions. And to give you first an overview of what we have done at ECB, our colleagues in central banking have started with an economy-wide climate stress test, and they concluded the stress test last year. And it was a rather top-down approach, so based on ECB data, very extensive data, financial data, but also climate risk related, compiled by the colleagues based on the NGFS scenarios phase 1. And this stress test informed our really recent climate stress test from supervisory perspective. And this stress test was performed rather as a bottom-up approach. The background of the stress testing is that it's part of, it was part of our supervisory expectations, which we have published in 2020, really formulating some guidelines to the banks, how to face this new risks, how to implement risk management tools and be able to manage this risks in the future. And after some first assessment, we have seen that banks still need to progress in certain areas. And therefore, this year in 2022, we have performed on the one hand this climate stress test, but also a thematic review covering really all of our expectations. And recently we have published, or recently meaning yesterday, we have actually published an extensive report summarizing all of our results, where the banks stand, and also some good practices. But let's dive into the stress test world. Yeah, indeed, Pierre, as you said, it's not easy to design a stress test which really has meaningful results, and therefore we as a supervisor need, of course, make some choices, and the first obvious choice is to really define a clear objective, and based on that to define the appropriate methodology, the scope we want to cover, the scenarios, if we want to include in the projection static balance sheets or allow for adjustments, and what are the transmissions channels we focus on. I don't plan to go into a lot of detail here. We can do it in the discussion in case of interest, but just to mention that from supervisory perspective, this was the first really climate-related stress test performed, and it was designed as a joint learning exercise, meaning to really inform both banks and us as supervisor on what is currently there, what can we do to assess these risks, what are also limitations and challenges we currently have, and identify some good practices already existing on the market, how to tackle these risks. And therefore, compared to our normal stress tests, which result in capital requirements, this year it was rather integrated in a SREP in a qualitative manner. And since it was a learning exercise, we have not only conducted a bottom-up stress test, but we divided the whole stress test into 3 modules. And in the first module, we rather asked banks a lot of questions on their internal stress testing to see what stress testing frameworks are currently implemented in banks, how are they designed, how well are they integrated. In the second module, we kind of took a point-in-time assessment on how dependent are currently our supervised entities on carbon-intensive sectors in terms of their income, and how vulnerable are they to transition risks due to carbon emissions. And the third kind of module, which is also a very complex one, was the bottom-up stress test. Scenarios we based on the NGFS, which we complemented with some elements, and we used the static balance sheet for the short-term scenarios and dynamic for some long-term paths. And in general, we focused on credit risk, but also considering the other risks. But I think we will go into this in our discussion. It's the question where to start, and credit risk is definitely one of the main transmission channels relating to, relevant for banks. Let's have a quick look on the results. And I have chosen some which I would like to present here, and to also show, based on these examples, how we as a supervisor now, trying to what are the consequences we are taking from that, and what is the way forward. So in terms of internal stress testing frameworks, we have seen that some banks made quite some advancements, but 60% of banks really have not yet an integrated climate risk stress testing in place. And also with respect to the credit risk module, some banks have implemented really the integration of climate risk, how it translates into PDs, and so on and so forth, and then losses. But we have seen from our bottom-up stress test that actually, depending on the scenarios, so the actual climate risk shocks, the credit risk parameters haven't reacted that strongly. They were often, as to say, insensitive, showing that the integration of climate risk in the credit risk models is not very advanced in most of the banks, and should be therefore advanced. And In the first slide, I didn't go into it in detail, but what we have done after the thematic review and the climate stress test exercise, we have summarized all of our bank individual findings and shortcomings in dedicated letters to banks with deadlines. So this is kind of our approach to foster the progress of developments of frameworks within the banks. In terms of vulnerabilities we've seen on transition risk, we've seen that overall, one can say that our supervised large institutions are quite dependent on carbon-intensive sectors. If you go into detail, it really depends on the business model and the type of exposures, but overall, it's still quite significant. And this, of course, means then that the risks behind those carbon-intensive sectors are then, of course, dependent on the transition plans the actual clients have. And here we have seen that, some banks have some information, but most of them still need to get really in contact with clients to find out what their transition plans really are. And the contact with clients is even more important with respect to data availability. So I think this is one of the biggest topics and also one of the reasons why some frameworks aren't yet that far, because banks says, okay, of course, those kind of modeling makes only sense if you have proper input coming in. So we have seen that banks were able to fill all of our tables. So they were able to provide data, but they were still quite reliant on proxies. And within these proxies, the issue is that some banks have different approaches, and also the data providers, and there are several of them, they also have different approaches to kind of try to estimate for example, carbon emissions. And the issue with that is then, of course, that there are quite some differences, sometimes even for the same counterparty. So also here it's very important to engage with clients. And as last point, since I mentioned that some banks have actually developed quite some good approaches already, our intention with the whole exercise was also to make this in an anonymized way available to the whole industry. So we have summarized all the good practices relating to all of our expectations, and it was published yesterday, actually, so on the general climate risk management. And with respect to stress testing, this will also be done later this year. So in December, we will also publish something dedicated on climate risk stress testing.
Thank you very much, Julia. So that's a very broad overview. I think that sometimes go beyond stress tests of the supervisory approach of the ECB.
It's all connected, therefore.
Let's turn now to Cassandra. What was the Bank of England approach? What did you learn, and what do you want to say about your going through a stress test?
Well, thank you. Just checking, you can see the screen?
Yes, I can see the screen.
Okay, and just to clarify before I start, is that our exercise, we don't describe it as a stress test because it wasn't a stress test. We call it an exploratory scenario, so CBER's Climate Biennial Exploratory Scenario, because it tested the outcomes of potential future climate scenarios, and we don't consider them as extreme stress scenarios as, say, you'd have in a traditional stress test. So that's just something I want to clarify at the start. Okay, So in this slide, it just gives an overview of some of the results of our stress tests, which I'll go into, not stress tests, CBES exploratory exercise. So in our exercise, we included both banks and insurers. So some of the biggest banks and insurers that are regulated within the UK market. And the overall results are summarized on the screen. So we had three main scenarios, which all banks and insurers modeled. The scenarios were based on the NGFS scenarios broadly with some adjustments. And the scenarios considered like different levels of physical and transition risks. And like overall from our exercise, it demonstrated that banks and insurers are likely to be able to bear the cost of the transition, and the exposures were highest in the severe physical risk scenario. So this is the scenario where we had what's called a no additional policy action taken to mitigate the effects of climate change. And overall, the results show that climate change and its impacts will be the lowest with an early, well-managed transition. And the most extreme results were seen in the no additional policy action scenario. And then something that to consider is that we are aware that the climate scenario analysis is still in its infancy, and there were like notable like data gaps, some of which I'm sure we'll cover in the panel. And the purpose of the CBES was a learning exercise. And so to drive like some improvements and understanding of, say, for example, the data gaps and the improvements needed in risk management. Okay, so in terms of some of the key lessons that we learned from our exercise. So overall, we found out the firms that took part in our exercise, they are making good progress in terms of their climate risk management, but we saw that firms still need to do much more to understand the full extent of their exposures. So our CBES was a first step for many of the participants in terms of them carrying out climate scenarios. And so more work will be needed for them to do to build their capabilities and understanding. We also found data gaps, as mentioned, to be a really common issue, and which meant that some of the climate risks were only partially being measured because of gaps in data. And we saw these gaps in a number of areas, and including firms' ability to get the information needed on emissions from corporate counterparties, and specifically for banks, there were data gaps on some of the energy ratings of properties on their mortgage books. There was also a lot of reliance on third-party modelers to carry out the modeling for the firms that took part in the exercise. So going forward, this means that there's a need for firms to improve their own capabilities so that they can scrutinize the models and also potentially develop their own in-house modeling to reduce the dependency on third parties. So in this slide, I'm just going to go through some of the key design choices that central banks or supervisors would need to think about in terms of designing a climate scenario exercise. I've highlighted just 4 on the slide. And the first is the choice of scenarios to use. So a large number of central banks and supervisory exercise use the NGFS scenarios, which was the basis for our exercise as well. But I think the main question is which scenarios to include, and that really depends on the scope of the exercise. So in our exercise, we wanted to test both physical risks and transition risks. So that may be a consideration depending on the scope of your exercise. And another important consideration is the time horizon which you want to consider. So our scenarios were based on like a 30-year time horizon. Another thing to consider is whether or not you want to do a top-down or bottom-up approach. From our research, obviously a top-down approach is less resource intensive, and there's probably more control in terms of how consistent the outputs are. But if you do a bottom-up approach, which involves the actual banks, insurers, financial firms doing the analysis themselves, that allows for like more understanding within the industry, and it probably helps in terms of that journey of collecting data and engaging with counterparties. So it does also mean that a bottom-up approach would take a longer time to carry out the exercise. And we did do a bottom-up approach because, as mentioned before, a key objective of us was a learning exercise so that the firms we regulate can develop the skills and build the capabilities for doing climate scenario analysis. Another thing to think about is the structure of the balance sheet, which you're asking firms to use. So whether you want firms to use a static, dynamic, or hybrid approach. So we actually use a static balance sheet approach, which meant that over the scenarios, the same, essentially the same business model was assumed, and the same balance sheet was assumed as a proxy. And so obviously that doesn't allow for future management actions or strategic changes that the firm may take to respond to climate change. But the reason, one of the main reasons why we did a static balance sheet was to make it easier to compare the scenarios so that we could understand the impact of future climate pathways on the balance sheet. And it was just easier to do that comparison with a static balance sheet. And also another thing to consider if you're using the dynamic balance sheet, it could mean that management actions which are actually decided could assume that could be like optimistic in terms of the industries or the strategies that firms may use to kind of move away from highly polluting industries. And the final aspect to think about is also the granularity. So whether or not you want to test exposures at the macroeconomic, sectoral, or counterparty level. So for our exercise, we asked firms to consider like climate exposures of their counterparties, which was more resource intensive. But again, it just helped in terms of that data gathering and firms understanding the risks that their counterparties face. So these are some things to think about in terms of the scenario design exercise. So I'll stop there, and if there's any further questions, feel free to ask in the Q&A so that we can cover them in the panel. So thank you.
Thank you, Cassandra. But before we move to the questions, let's have Dan presenting the last stress test exercise from the Swiss National Bank. I mean, the Swiss sector is somewhat smaller than what we've seen, but I guess you can also maybe have some specificities that I was looking at.
Yes, thank you very much, Pierre. Thank you for the invitation. And also thank you to the organizers of the E-Axis Forum and the EBI for setting up this webinar. It's really nice to be here. So first off, I would like to state that the usual disclaimer applies. The views expressed here are mine and not necessarily the SNB's. And I would also like to clarify the SNB's role in the whole banking regulation. Our mandate is to contribute to financial stability. However, we are not the bank regulator, so we don't write the rules. This role belongs to the Swiss Financial Market Supervisory Authority, FINMA. But of course, in this topic, we closely work with FINMA. So let me just give you first an overview over what we did, and then some of the main lessons. I will try to keep it short, so there is enough time for discussion. So together with FINMA and the banks and the University of Zurich, we earlier this year concluded a pilot project to assess climate-related transition risks at the two big banks here in Switzerland, UBS and Credit Suisse. So as we are a smaller central bank with more limited resources, we had to narrow our focus on what interested us the most. And this was, as I said, transition risk, because it seemed to us at the time, and still does, that transition risk is potentially more acute in the short term than physical risks. We focused on the GSIBs because they may be more exposed through their international lending operations to climate risk. And our economy, as you may know, lacks heavy industries, carbon-intensive industries. So we were more interested in that, and we looked at equities, bonds, and loans. We also included hedges and collateral. This just represents the bulk of the bank's exposures. So basically, there were three parties at work here. The banks, who provided us with exposures and sensitivities, very granular, like from 600 NACE sectors, 4-digit. Professor Battiston from the University of Zurich, who is a leading academic in this field, provided us with sectoral shocks that he derived from the NGFS scenarios, and FINMA and SMB then took this information and calculated loss potentials. So the main lessons, I would say, also in our case, it was first of all a learning exercise and important for capacity building at the involved institutions. And we learned much about the exposures of the banks. For example, they do not seem to have, like, compared with the market, to have unusually big concentrations of exposures to climate sensitive sectors. This, of course, doesn't mean that the problem is solved, because the market as a whole could be wrongly positioned, but it's just an important, information to get out of the way first. We did not publish more quantitative results because, from our view, in order to make a more robust assessment, further analysis are needed. For example, there are lots of different methodologies out there which produce a wide range of results, and we feel that we shouldn't base our conclusions on the results of only one methodology, but multiple methodologies. So in the future, we are planning to implement other methodologies. We are currently evaluating some of them, and again, with collaboration with FINMA and the banks. And so we hope to, be able to compare the results and especially, better understand the underlying risk drivers and how the various assumptions play into the results. So I'm gonna stop here and open for questions.
Thank you very much, Tan. So please feel free to ask questions in the Q&A. While this is filled up, I will have come with 2 questions from my side in 2 directions. So you can choose which one you want to answer and which one you don't want to answer. My first question would be, what was the industry feedback that you got? Not really. I mean, Julia and Cassandra, you said that the industry was not always prepared for that. But what were their feedback in terms of, I don't know, how useful they find this exercise, what are missing to them, this kind of feedback that you learn from them. And then my second question goes along the definition of scenario. So Cassandra, you also rightly pointed that you had like a scenario analysis, not a stress test per se, not a stress scenario analysis. There is a lot of question about how stressful the scenarios, for example, from the GFS are. Of course, there is a shock, a climate shock, but along this shock, all everything is adjusting quite smoothly. So it's not really a strong shock. Julia, you mentioned that you looked at credit risk, but ECB's results also suggest that what will react first is probably a market risk rather than a credit risk, because the front load the risk. So how and then the last question is about how like the worst case scenario when nothing is done, how really stressful are these scenarios? If we have a total collapse of the economy in a sense because of climate change, the scenario really stressful. So how can you build something that is meaningful in terms of stress, but still plausible? Are there really hypotheses there that you should prioritize and choose on? So I let you with these 2 questions. And then I will try to collect the question from the Q&A. Who would like to answer first?
Do you want me to go first? And please obviously jump in if I have missed anything. So in terms of industry feedback, so the banks and insurers that did take part in the exercise, so the feedback from them was generally very positive, because as mentioned, it was the first time that they had carried out the exercise, and the exercise was learning. It wasn't used to set capital. It wasn't used to it wasn't used as part of our usual like supervisory kind of like yeah, it was exploratory. So basically we had like after the firm submitted their results, we had feedback sessions with them, and we did give firms individual feedback, but had they not had done the exercise, they would not be aware of areas of limitations. And especially for PRA, we'd released communications last year that said that this year we expect firms to embed climate risk management as part of their business as usual, as part of business as usual supervision. So having specific feedback from the CBIS exercise was helpful in terms of firms kind of planning out what they needed to do in future to build those capabilities they needed. So for that reason, the feedback was quite positive. And then also after the exercise, we had like a forum for the firms that participated, so they could share learnings, share difficulties, share ideas. So from that perspective, firms did find it useful. And I think your second question was about the stress scenarios versus the exploratory scenarios. Is that correct?
Yeah. How to make stress scenario really stressful physically.
Yeah. So I think this goes to one of the questions that I did see in the Q&A. So when it comes to climate, because we don't actually know what the outcome will be, and a lot of in terms of how the outcome is going to be, so when it comes to transition, it's very much like policy related. It's very much dependent on technological advancements, or say advancements in, say, for example, say green energy, and it's quite kind of can be quite uncertain in terms of how that is going to play. So when it comes to our scenarios, we call them scenarios because they are potential examples of what may happen when it comes to climate, but we don't think they're necessarily the most extreme case, because the most extreme case would be we just don't know how kind of there's basically a wide variety of what the outcomes could be. So when it comes to our scenarios, we think that they're plausible scenarios which could happen, which is why in terms of the outputs that we released on the website, it was kind of within firms' tolerances, but we feel that they could be worse. And compared to normal stress tests that the Bank of England does do, they're not necessarily the most extreme of events that could potentially be possible. And as I said, because there's such a wide uncertainty in terms of what outcomes could be for climate, we don't want to use the word stress test to describe them. We call them exploratory scenarios.
Thank you.
So, I mean, if I may just jump in here, I fully agree with Cassandra. I mean, we just don't know how all these paths or different scenarios will play out. But I just want to emphasize one point. I wouldn't say they are, or I don't have a clear view on if they should be more severe or less severe. But an important point is, depending on how you model the stress, you can come to very different conclusions, right? I mean, just for example, if you look at transition risk, you can say, okay, market participants, they will front load, the whole 30 years. Suddenly there is this Minsky moment, the realization that for example, oil, the prices will be much, much higher, and industries will not be viable. And then everything happens today. So you are allowed to model the stress like this, right? And you will get significant results. You can also decide on what kind of discount rate you want to use. You can use a high discount rate. You can use a low discount rate. With a high discount rate, future losses will be lower today, and vice versa. You can decide on a certain baseline scenario. You can say, okay, the market didn't price in anything today, or it priced in already, a certain, like a nationally determined contribution scenario or a late transition scenario. And, comparing from this baseline scenario, you will also get more results. So in short, my point is the NGFS scenarios, they leave a really wide space open on how you want to go about your modeling, right? So that's why it's hard to say they are too severe or not severe enough.
Maybe to shortly complement on this. So we have complemented the NGFS scenarios by also front-loading some transition risk, but we have also seen that since we haven't used kind of a severe or really stressed scenario as we do when we are stressing the economic financial impact, so in our usual stress test, that still our stress test didn't result in very severe outcomes. So I think it's a fair question to say, what can we stress more? And currently we already see that energy prices can hike suddenly. So it would be good to see and to know how banks are really impacted by such quick changes from climate perspective, and which banks are most prepared and most affected, and how are they prepared to address this. And the sensitivity of the scenario outcomes, as I mentioned in the beginning, is of course also very much dependent not only on the data you put in, but also on the models. And therefore it's so important that banks progress in really implementing how climate risk really translate then in their credit risk, market risk, and so on and so forth, and then ultimately in losses.
So I also have something just very quickly to add. So as part of our exercise, we had a quantitative component and also a qualitative survey. So in the survey responses, we were able to gain some indications of firms which had considered potentially more adverse scenarios. So we were able to gain some insights that way. So that would have been outside the main core scenarios, but we were able to get some insights from firms into their views of more extreme scenarios as well.
So one issue that comes is basically the lack of data that banks or financial institutions are facing. So what would be possibilities for them to improve that? So do they really rely on standards bodies setting making the job for them, or can they do something on their side? And that's also related to two questions from the Q&A. So would, for example, if supervisor were to give templates about what to ask to their counterparties, or give guidance about what kind of information they should require, would that be possible? And another question is about the harmonization of the stress test between supervisors. Do you think that there is a trend to work together to give a financial institution the same scenarios or the same model? Would that be beneficial, or is that, what do you think on the opposite, that it's better for each supervisors to look at what their are worried the most, for example. So this is the kind of question that we have here. Julia.
Maybe to first respond on your question on data availability and how to improve this. They are indeed the challenges that data really received from reportings. Publication is still quite rare. I mean, there are a lot of initiatives, so it will come. But banks cannot wait for that. So in the meantime, they need to develop proxies and use, in addition to that, also databases, which are also sometimes, so the data provider use then some modeling to try to estimate, for example, emission data. Here, indeed, and that's the question which we were asked also by our supervised institutions, what would be kind of the approach you would like us to take? And therefore, this is one of the things which we, for example, would then describe in our kind of good practices. So approaches how to develop meaningful proxies on the one hand, but on the other hand, I think there is no way of, or there is definitely a need to engage with clients and ask specific information from clients. And also here, we tried to help in a sense to kind of describe what banks, having developed some good approaches, are doing currently. But the interaction with clients is crucial, not only on data, but then also on how they actually then the clients plan to reduce their emissions, and this is so to align, for example, to net zero. There are also databases for that, but client interactions are crucial.
Hi, and can I add to Julia in terms of, I agree with what Julia said, and just to add more specifically about the part of the question where you were asking about, I think, the consistency of scenario analysis between different jurisdictions. I think that's the question that was asked. There's only some extent we would be able to do it. So say, for example, the CBES exercise that the Bank of England did, yes, we did use NGFS as a basis, but we also made considerations for specific UK transition plans, which we used to supplement the NGF scenarios. And we also had, supplemented with specific UK scientific data, like from, say, our Met Office, to kind of for some of the physical risks element as well. So on both the transition side and the physical risk side, we did supplement the UK specific scenarios with certain information, and that would cause some natural differences between, say, for example, like another jurisdiction potentially. So our exercise, we very much like for UK exposures, we focus on, say, UK elements of the transition and what we knew in terms of some of the UK physical risk losses. For exposures that firms had, which were more international, they would be more kind of based on, say, direct NGFS scenarios. But it's just something to think about when trying to make considerations between, or trying to look at differences or similarities between different jurisdictions. There may be like specific transition policies that one country has in place, which would naturally cause differences in results. That's, I think, something to bear in mind as well.
Maybe on data. So I believe as climate change is a global phenomenon, the metrics or the definitions of data should also be consistent across jurisdictions. So there can be a comparability. So many, from my experience, the banks try to, develop their own metrics or participated in organizations that developed those metrics. But in the end, it may be, it's not a futile effort, but if the definitions are too far apart, the data is not as useful anymore. So there I really see a big role in, for example, the TCFD framework could potentially improve on this issue, but unfortunately, they did not define specific metrics, but rather metric categories. So yeah, we'll see how that plays out. Maybe regarding harmonization of work across supervisors, again, it would be very, very nice, but as Cassandra said, there are differences across jurisdictions that need to be taken into account. There are also important, so some data or methodologies are from vendors that's not, so supervisors may not be able to pass on certain information or data. So again, it's, I guess, on a bilateral basis to try to harmonize, it's quite tough. Again, there I see an important role for the NGFS to continue its good work there.
And maybe to lastly mention on NGFS, they published now some approaches how to really bridge this data gaps, asking especially, of course, also kind of from policy perspective, much more harmonization to allow comparability. So, I mean, energy efficiency certificates, I mean, they're not harmonized. So, so there are lots, I think, of harmonization which needs to be done. So I fully agree.
Two further questions. You might know that the Financial Stability Board is kind of taking a holistic approach of managing climate risk, also looking at the interdependencies between sectors of the financial industry or the insurances. So Dan, you mentioned that you take into account the hedging possibilities of firms. Cassandra, you said that you also you also stressed, or you also provided scenario to insurances, not stress tested them. So what are the big challenging or opportunities to also look at the insurance sector? And a second question is about how you can use scenarios to inform policy decision. I mean, there is a looming question about using that for risk-weighted computation, but more generally, these kind of stresses can also inform other the decision in the monetary policy area. So, how can they be used, and if they cannot be used yet, what development needs to be made to come to something that can be used by policymakers?
Okay, so if I'll start first with the insurance question, given that we include insurers. So I think for us, one of the main benefits that I feel that we saw about including both banks and insurers was to see the differences or consistencies in approaches that both institutions or both types of firms were taking. So from our exercise, we saw that insurers have better capabilities to model in physical risks than banks. The reason being, as part of an insurance business, you typically look at natural catastrophes as part of your business as usual. So you look at, say, frequency of weather events. You'll have granular detail about where your insurance policies are. So you can do like more granular, say, for example, analyses of physical risk, and the models were generally more in place, albeit they had to be adjusted. So we found that banks didn't, as standard, have those capabilities. So that's one thing we saw and we learned from the exercise. So there's a lot that the industries could learn from each other, and by including the two sets of financial institutions, it was helpful for us to know like what could be done, because if, say for example, we didn't include insurers, we might not know that, say for example, certain types of losses can be modeled as they are done within the insurance industry anyway. Also with insurers, so I mentioned in the presentation, we looked at physical risk and transition risks. We also, for insurers, we looked at litigation risk as well. So that was the risk that directors of a company could be sued because of maybe decisions they made which were negative when it comes to climate change. That was also an additional part of the scenarios which we did include for insurers as well. And I think another main benefit of including both insurers and banks was when it came to looking at some of the qualitative responses to understand what, say, risk mitigation options that financial firms would follow. So quite a few of the banks were saying that insurance would be a risk mitigation. So say, for example, when it comes to, say, physical losses or impacts of climate change, whereas the insurers were saying, well, in certain situations, we wouldn't provide the insurance. So that kind of implied that actually there's a disconnect. The likely the insurance is not actually going to be there, even though the banks were assuming that the insurance would be there. So that was also another benefit. So we were able to take, say, further views about say, potential like parts of the country where homes may not be insured, which may mean that mortgages to buy homes will not be made available. So had we not had included both banks and insurers, we wouldn't have got those insights from the exercise.
I don't know, Julia, you want to rebound on these two questions? Or?
One addition, I fully agree with Cassandra that that the banking industry can make use of some developed approaches, especially for physical risks from the insurance sector. This we really have seen that, especially for physical risks, banks still are searching for ways how to look at that. In terms of also the interplay, so looking really forward, how can we advance our scenario analysis is that, of course, insurers react to climate risks by increasing, for example, their policy costs, which then impacts the households or firms. So in terms of costs, which then translates again in their ability to repay certain loans. So there are, of course, a lot of interactions, and I think this would be kind of the next steps. And also, understand that here we probably need to join forces and to see how can we actually model that together. So
maybe I can say something on the policy relevance. I guess right now, what surely would help to make it more policy relevant would be to if we were better able to integrate climate risk in our conventional stress testing models. So I think a big inhibitor right now is how to reconcile the different time horizons. So if we could somehow have shorter time horizons and still taking into account the long-term nature of climate risks, we would be better able, to relate these to our traditional stress testing and then maybe derive some policy conclusions from there. Another point is I would like to see a more consistency in the approaches taken, because as long as there is, you know, a wide range of approaches and results out of climate stress tests, I guess it's hard to formulate then policy based on this. So there should be, like I said, consistency, some consensus on how to do these things, how to assess climate risk.
Thank you very much. Julia.
Performed our maybe last thing. So indeed, as Cassandra said, and our exercise and your exercises are all these learning exercises, and I think this brings us in a position to really start now to develop something harmonized, because before that it was so much harder because due to the complexity of the topic. And to address maybe from my perspective, really one of the important topics besides kind of our supervisory view is, of course, the general disclosure requirements for firms. So not only for financial institutions, but of course for corporates, because the harmonization on that end, and the more we can get in a standardized, harmonized way, the better. So
we've reached the hour. So if you want to say a last word, that's your last opportunity. Otherwise, we will close. Let me, before we officially close, just remind the audience that the next traditional E-Axis webinar will be held next week, next Monday, on the paper The Great Carbon Arbitrage by Alisa Klein-Jujuis, I don't know how to pronounce it, from Stanford Institute of Economic Policy Research at Stanford University. And you can check in the chat for more details, or on the website of the Axis. Let me thanks again the EBI for having contributed to this panel. Thank you to the panelists. Thank you, Cassandra, Dan, and Julia. I hope that you enjoyed it as much as I did. And for the audience, let's see in 1 week. Thank you very much.
Cool, thank you.
Thank you very much.